I'm joined from Singapore this morning by Daphne Roth, who's the head of Asian equity research at ABN Amro Private Banking. Daphne, let me talk to you about the losses we saw on Wall Street. What does this mean for Asian stock markets?
Currently we are slightly overweight emerging market, but I am seeing a lot of headwinds. I think you have mentioned that we seem to see a global synchronized slowdown. If you look at the recent China PMI and retail sales, I think it's definitely slowing down because of its monetary policy tightening. And also in the U.S., we continue to see that the ISM manufacturing new order has hit 51, which is the lowest since June 2009, and that means that export is going to be softer for Asia at the end of the year. So it doesn't look that good. And of course, next we will have the exit of the QE2, which could mean that cost of capital could go higher, and that's not very good for equity as a whole. And furthermore, we have also seen that results in the first quarter was a bit mixed, but a lot of the earnings revision breadth has turned negative for most Asian countries. Currently, 4 countries under our coverage are the only ones that have positive earnings revision breadth, and that is Thailand, Korea, China, as well as Hong Kong. And of course, we are also seeing other headwinds elsewhere.
Okay, well, let's talk about China in particular, because you're overweight China. China-Hong Kong markets coming back from the Dragon Boat Festival yesterday. But, CPI numbers just around the corner. We're expecting 5% inflation once again, and we didn't get that interest rate hike last night as many predicted, but, some say it's just a matter of time.
Yes, we see perhaps another rate hikes for June, and that will be it for this year, because we believe that inflation has kind of peaked by the first half of the year. That's what our global economics guys think, and we should only see one more rate hikes. But we do not rule out other administrative tightening, maybe increase of the required reserve. But I think China is pretty much ahead with the tightening, so only one more rate hikes for China.
Okay, so that's why you're overweight on China, and you're saying that stocks are cheap. Talk to me about sectors then. Banks seem to be pretty cheap on a price-to-book ratio.
Yes, we like Chinese banks, and China is pretty cheap now after not doing that well. The valuation is cheap. We still see decent earnings growth, and we like Agricultural Bank of China. We just initiated coverage with a buy rating, and we see loan growth that will be boosted because it's exposure to the rural area. And we also saw that net interest margin continue to expand because they are much more exposed to the lower cost of demand deposit, and also even the non-interest income continue to grow because of the wealth management side. And I think a lot of the concern on non-performing loan that has improved a lot from 2.46% down to 1.76%. Yeah.
Daphne, give me a 30 seconds takeaway point here, because you sound pretty bullish on Asian stock markets. Can you tell me about re-entry? I mean, what's a good point to be picking off the bottom, and why are you so confident?
I think that Asian markets are pretty cheap now, and we have seen that fund flow has been negative. So, if you compare to the developed market, perhaps we wait for a couple of months until, we can see some direction, and I think that would be a good entry point.
Okay, Daphne, thanks for joining us today. Daphne Roth of ABN Amro Private Banking joining us from Singapore.